Today, I'm going to provide you with important information regarding how a change in reporting leases could negatively impact loan covenants and other financial ratios used when evaluating small businesses. The effect of the new lease standard could have a significant impact on the balance sheets of these small companies. I'm going to provide you with a brief overview of the standard that's in effect for non-public companies in 2022. I am Kim Fonda. I'm a partner here at Fogg-Casson, and I've been with the firm for a long time. I am currently our Director of Accounting and Auditing Services, and basically what that means is it's the area associated with financial reporting. So I want to start with what we've always known. So the previous standard for leases, there were always two types of leases. We had our capital leases, which are recorded on the balance sheet along with the debt. So it's pretty much like any asset that we would purchase outright. And then there's operating leases. So that's typically your rent expense, auto leases that you're not going to own at the end, machinery, equipment, that kind of stuff. So with the new standard, there's still two types of leases. Now the capital lease is going to be called a finance lease. Basically, same kind of thing. They're the assets that you purchase at the end of the lease. They still end up on the balance sheet with in your assets, and you put the liability on the balance sheet as well. And there's still operating leases. The only difference now is that all types, operating and finance leases, will be put on the balance sheet if they have a term of greater than 12 months. This is going in effect for our non-public companies for years beginning after 12/15/2021. So that's our calendar year 2022 financial statements. It's important to note that this is effective for GAAP basis financial statements. So if you have tax basis or cash basis financial statements that you're used to seeing, this will not impact those. This is for GAAP basis financial statements. I want to start out with showing a lease comparison between what it was and what we'll be seeing going forward. So let's look at a copier lease that was effective for 2/1/2022. It does have a bargain purchase option at the end that we will be taking advantage of, so we'll end up owning it. It's going to be a 5-year lease. And the present value at the start of the lease was $4,530. So basically, under the old standard, we had fixed assets that would have been booked. And again, we're looking at the end of the calendar years. So the fixed asset at the end of 2022 would have been $3,628. We have our liabilities on the books of the short-term and long-term liabilities, and then the interest and amortization or depreciation expense that gets booked. And our expenses on the lease are going to be $932 and $991 in the second year for, again, the lease-related expenses. So under the new standard, as I mentioned, it's pretty much the same. You can see you have the same debt, you have the same right of use asset, which is actually the only thing that changed is now we're calling it a right of use asset instead of just grouping it in with fixed assets. The income statement, no change there either. We have $932 expense the first year and $991 the second year. So now with an operating lease, let's take a look at that. This is, like I said, where the differences really comes into play. So we have an operating lease for an office space. It begins on 1/1/2022. The term is 10 years. Monthly payments were going to be $1,000 and increase $25 each year. And the lessor, the landlord, is not making us make payments in January. So when we look at it under the existing standard, we have nothing in our fixed assets. And we do have some deferred rent because we look at it kind of on a straight line basis over the life of the lease of 10 years. So we have some deferred rent in each of the 2 years. And our operating lease expense is going to be the $12,238 because it's, again, straight line for the 10-year period. Under the new standard, though, while we look at the income statement, at the bottom, the operating lease expense stays the same. We now have a right of use asset of $90,960 on the balance sheet, as well as a lease liability of $92,187. That's just for this one lease. So again, no change on the income statement, but the balance sheet shows a significant difference. So what do we have here as potential issues? I mean, as you can see, again, from the operating lease, there's a significantly larger amount of short-term and long-term liabilities, and then an increase in our assets as well. So we want to think about what's going to be the effect on our loan covenants. Existing covenants, granted, they were a lot of them put into place before the leases were going to be on the balance sheet, so it really wasn't a consideration. But now do we have to think about, what is going to be considered debt? Would those short-term lease liabilities be part of our current liabilities, our current debt when we're looking at our covenant ratios? So making sure that we have it clarified as to what should be considered. Is it debt before this lease standard, or should we be carving them out specifically? Something that we absolutely have to consider. And also there's a related party issue. Small businesses, oftentimes the owners will own the leased property in one entity, and then they lease it to the operating company, which is held in another entity. And, we bankers, and we would be looking at, each entity, and we'd see the fixed assets on the lessor and just the rent expense and rent income, kind of net out. Well, now we're going to have the fixed assets on both companies, and there's going to be liabilities potentially on both companies. So we want to make sure that we're not double counting it when we're looking at the owner's assets and liabilities as a whole. Some considerations, again, now with the leases on the balance sheet for calendar 2022 GAAP statements, would it make more sense to get income tax-based statements? When you get tax-basis statements, if the tax return is prepared on an accrual basis, so you still have AP and AR, there's really not going to be a big difference between what you would have seen on the prior GAAP statements than what you would on the tax basis statements. Depreciation is going to be a little bit different, but most everything else is pretty consistent. Or, as mentioned, do we need to make some adjustments or clarifications to the loan covenants to make sure that this doesn't have any unforeseen consequences? I had wanted to let you know that I will be available for any questions that you may have on Monday, November 21st from 9 a.m. to 10 a.m. and Tuesday, November 22nd from 2 p.m. to 3 p.m. via Teams. You can log in and ask whatever questions you have, or you can reach out to me at KAF@Fawcasson. Our phone number is also here on this last slide. If you have any questions, please don't hesitate to reach out.